they finally dropped the nuclear bomb on CPF. No more special account. But what else can you do? Hi everyone, this is Pete here. Welcome back to the channel. So today I want to talk about the hottest news right now that is going through all the news channel, and in fact DPM Lawrence Wong even had to explain himself again on television on this removal of a CPF policy. Now, what is this removal? I think by now, those of you who are not living under a rock, okay, you will know that there was a change whereby there will no longer be a special account for those of you who are past 55. Now, for my younger viewers here, okay, if you're wondering, hey, what's the big deal? What is this special account thing, right? Okay, so you can actually go to the CPF website to have a look, but let me just illustrate here using the CPF policy. Okay, so in the past, when you hit the age of 55, right, okay, what will happen is that there will be this new account that's created for you called a retirement account. All right, and it will take funds from two places, all right, the special account and the ordinary account. Now, the interesting thing is that it will take from the special account first, all right, and if there's still space in the retirement account, okay, you can read out about this thing called the FRS, full retirement sum, okay, then they will take from the ordinary account. But there is a problem here, right? The problem is that special account actually pays a higher interest, right, of 4%, whereas OA only pay 2.5%, okay? So what people in the past used to do is that they say, hey, why don't I force my retirement account to take money from my OA first, so that whatever money I have left in my special account will still generate 4%, okay? And what they will do is that momentarily, right, when they turn 55, they will take the special account money and buy into something such as a treasury bond, alright, or something that's relatively risk-free to temporarily leave the money so that the system will look at the SA and say, hey, there's no money in the SA, so let me take the money from the OA, right? And then once it's already filled with OA money to the full retirement sum, then the SA is spared, right? Then the money can go back into the SA and continue to generate 4%. And at the same time, your retirement account also generate 4%. Okay. Now, this is a policy that will no longer be possible. So a lot of people are up in arms, very angry, especially in Singapore. There's this group called the 1M65 group, right? That is very upset about this. Okay. Now, first and foremost, I just want to say that this shielding policy has been around for the longest time. Now, I just want to start by saying that this is a loophole, honestly, that was meant to be plugged sooner or later one. Okay, so let me explain very quickly, right, why is the special account closed? Because think about it, the difference between OA and SA is that why is SA able to pay 4% is because it is meant to be a long-term savings account that you cannot withdraw freely. Okay, but the problem is that after 55 years old, once your FRS is full, you are free to withdraw from your special account if the special account still exists. So it really doesn't make sense for the government to pay 4% for something that is so highly liquid. Out there, it is really not possible. So to me, this is a loophole that was originally meant to be plugged sooner or later. In fact, I'm surprised that it took them so long to plug this hole, because this policy, if I remember correctly, has been around for more than 10 years, Alright, so if you want to find out more about this whole SA shielding thing, how it used to work, but honestly, I don't think there's a need, okay, because it's already over, it's already done. So let's move forward. The next thing I want to talk about is what can you do? Okay, so on the policy front, I will go through that first, what you can do on the policy front, and then later on, I will talk about what you can potentially invest in to replicate what you used to have from special account. Okay, but once again, if you find good value here and you like what I share in the channel, do remember to subscribe, alright, to this channel. Okay, let's go straight into it. Now, what are the few things you can do? The government did not just remove the SA without any additional help, right? In fact, what they did was they raised what we call the ERS, the Enhanced Retirement Sum, okay, to 4 times the basic retirement sum. I can tell you, our CPF policy, right, is so complicated, it's full of acronym, so hard to understand, right? I really implore the government to make this policy as simple as possible, okay? Right? So why is this important? Because if you still have a lot of money in your OA and you haven't hit your enhanced retirement sum, what you can do is that you can throw the rest of this money, right, into the enhanced retirement sum. So you still can get your 4%, okay? The only difference is that you cannot take out the money freely. So it's back to being the correct policy whereby it is paying you 4% because it is not withdrawable so easily. But I must say this is absolutely an optional choice. You just need to top up to your full retirement sum, which is actually 2 times your basic. Alright, in this case, I think right now it's about 200 something thousand. Okay, the rest you can still take out. Or what you can do is that once your SA has filled up your retirement account, the excess fund that will flow into OA, you can also take it out, okay, to invest. But remember this, OA itself is not such a bad deal. It still pays you 2.5%. It is not like you are sacrificing 4% to 0. So remember that the difference here is actually about 1.5%. But before I go into what are the possible alternatives and options that you can go for, right, do take note that there is a statistics that's being published by CPF that talks about actually close to half the people who actually invest their OA money end up worse off. That means they actually earn less than the guaranteed 2.5% when they invest elsewhere, which is supposedly riskier. You should actually get better returns. So if you're not really sure how to invest, I would still say that putting your money, leave it in OA might still be one of the best options, right? For those of you who are not so investment savvy. Alright, so what are the possible alternatives? Firstly, let's take a look, right, at what are you actually replacing. So number one, you're actually replacing the ordinary account type of returns, which is firstly, it is super safe. Secondly, the returns is 2.5% per annum, plus it is highly liquid. Okay, so the first thing I want to replace is, can I find something that's equally safe? Okay, and can I get maybe close to the special account 4%, and it must be higher than 2.5. Okay, so over here you can see that the number one will be T-bills, right? These are treasury bills that the Singapore government issue and you can buy with your OA money. And in fact, right, guys, after 55 years old, you want to withdraw however much from your OA money after you have fulfilled your FRS, is solely up to you, you know. So actually, you are investing with pure cash. So your options are 100% wide open already. Okay, now if you look at T-bills over here right now, you can see that one of the latest T-bills, it is actually at 3.66%, right? But having it at 3.6% sounds very good, right? More than 2.5, quite close to 4%. But bear in mind, this is because right now we have a high interest rate environment. There is no guarantee that this percentage will continue. In fact, T-bills generally only last between 6 months to a year. So you don't know what this rate will be. After 1 year, it could be much lower from here as well. Second thing is actually something very unique to Singapore that is being provided by the government, which is called the Singapore Savings Bond. Now, Singapore Savings Bond is slightly different from T-bill because it is actually a 10-year bond, right? So this rate that you lock in right now, for example, the latest Singapore Savings Bond, or we call SSB, is 2.88%. So it is not as high as T-bill, but you at least get to lock in this rate for 10 years. But the thing is this, it is not a lot higher than OA account of 2.5, and you have to, do the buying and selling, and in between you might miss 1 month or 2 months, so actually your real returns might be even less than 2.8. So whether is it worth it or not, I think it's up to you to think about it. So next, I want to talk about what are the possible alternatives that are slightly more risky that you can think about to kind of supplement the returns in your CPF money. Okay, but once again, do remember to subscribe if you like what I'm sharing right now. Alright, so other alternative, number one that comes to mind is there some ways I can invest for dividend returns? Okay, and in Singapore, I would say, in my view, the most diversified way to generate dividend is actually a REITs ETF. Now, generally, I'm not a big fan of REITs if I'm buying individually, but if you're buying an ETF, you're buying a basket of them, right? So you can see over here, we have about 4 to 5 REITs ETF in Singapore. They are generating between 4 to 5% return. So that is actually already higher than special account. Okay, but do take note, over here, this is not 100% risk-free. There are some risks involved. It is just that because you're investing in the basket of REITs, your risk is already more diversified. And furthermore, due to the high interest rate environment in the past 1 to 2 years, the performance of REITs has really been punished. The price has been really, really low already. So right now, it might be an interesting time for you, right, to take a look at this if you want to think about a dividend replacement. Now, some of you might be asking, hey, Pete, should I consider in the US, because in the US, they have this thing called a dividend aristocrat or dividend king or whatnot, right? I would say I wouldn't do it because as a non-US citizen, if I invest in all these dividend stocks in the US, when the dividend comes back to me in Singapore, I have to actually pay a tax of 30%, right? A dividend tax. So that will greatly diminish whatever dividend yield that I will get from US stocks. Now, the second thing is what I will do is that with the cash that's remaining, let's say I have a few 100,000 and let's say I'm still able to take some loan at the age of 55, right? I will actually go for what I call a property income strategy, right? So instead of buying a fund that provides income, I'll create my own fund, right? This fund basically consists of one property and I will buy resale property. The reason is because resale generally is much cheaper than new launch and the rental can be similar or just slightly lower, right? So what I will do is I'll buy a rental property to rent it out, right? And get a good yield in the range of maybe 5 to 6%. So that is definitely higher than the 4% SA is providing. And on top of that, I think in Singapore, if you buy a solid property, there's very little downside risk, I would say, right? And the property generally, if you don't buy something that's too old, even the 99-year lease one should be able to last you as long as you are alive. Now I'm going up the level in terms of risk. The third one I'm talking about is, in a way, I wouldn't say is riskier, but is volatile, right? So volatility and risk is not the same. You can go and Google and find out what's the difference, but basically risk is when there's a permanent loss of money, whereas volatility is just a fluctuation in price. And what am I talking about? It is basically the very simple way of investing in market type of ETF. For example, if you are investing in the US, it will be SPY, QQQ, right? This kind of ETF that follows and mimics the performance of the US stock market. And these ETF are generally very broad-based, invested in many companies. So to me, the risk of total loss of capital is very low, but please don't go with the misunderstanding that this is definitely a risk-free investment. There are some risks involved. In fact, I would say the volatility can be quite significant. But to me, as a long-term investor, I welcome this volatility because it just means that I can buy more shares or even do option strategy when the price are much lower. Now, this brings me to my fourth point is that if I suddenly have 400,000, 500,000 cash that I wanted to put in my SA to generate 4%, and now I can't do it, right? What will I do with it? Now, this is perhaps the riskiest and the most advanced option. Okay, so in fact, I put down here as a note to remind myself to tell you that please don't try it if you don't know what you're doing, but I want to share as freely as possible on my channel, right? And that is basically what I teach on my option mastery class, which is selling options. Okay, now I will do a video on how to sell options in the future, but basically what you are doing is that it is like investing in the US stock market, but in this case, you are kind of selling insurance. Right? So instead of you buying insurance, this time round, you are the one selling the insurance. And just by selling this insurance, you can generate good options premium, ranging from 6 to even 9% a year, quite steadily. Okay? And the risk is not actually any higher than you just buying shares in the US stock market. Okay? So I will do another video in the future to talk more about this, but basically these are the 4 possible higher risk, but personally, I do prefer this option than buying into just T-bills and SSB because to me it doesn't make sense, right? In fact, I would love it if they say, hey, there's no restrictions at all, you can take out as much money as you want, because to me, investing in the market of properties or in the stock market will generate better returns than the standard 4%. Now, I think one important thing from this whole saga of the CPF policy changes, right, is that we cannot assume that anything that is risk-free to be totally risk-free because there will always be such a thing called policy risk, right? So over here, I just take a screenshot, right, of some news article that talk about, if you top up your baby's special account at a very early stage when they are first born, right, they will become a millionaire, in 50 years or something like that. But the problem right now with this strategy, okay, is that how certain are you that the rate of return of special account is going to stay at 4%? In fact, it is clearly stated in the CPF website that this return is not going to stay there forever. It is subjected to policy changes. So do take note, right? There is always going to be a policy risk. In fact, anything that is absolutely risk-free, sometimes to me, is the biggest risk because you will never have any further upside than what is stated, but you still have the possible downside. For example, a CPF policy change. So my main message here is really take control of your investment if you're planning for retirement or any other purposes, right? Play the game where you have control. You are able to control the outcome. Okay, for example, if I buy a property, I can control the outcome. I can say if I want the rent to be higher, I can make it nicer, or if I want to rent out as soon as I can, maybe I can rent it slightly lower. There are many things that I can do. Just like the stock market, when it's cheap, I can buy more. When it's high, I can sell some. But if you are relying on other people, even the government in this case, for your retirement, then you have little control. Then guess what? When things change, when policy change, then you are going to be greatly affected. And I think one other message that I want to share with everyone out there is that do not rely on a single solution for your retirement, right? Imagine those people who were previously maybe in the M65 community or other community, right? That solely rely on this 4% risk-free return every year for their retirement. Now they are in trouble. That's why they are making so much noise. But if you plan your retirement accordingly, right? CPF is just one component, but you diversify into other things, for example, property, for example, stock market, right? For example, some dividend ETF REITs that's bringing you return. Then you have kind of like 4 pillars supporting your retirement. Even if one of the pillar in this case, like the special account, is broken, right? You still have a standing portfolio that's going to support you throughout your whole retirement. Okay, so this is what I wanted to share with you guys after I thought very deeply about the recent CPF special account saga, okay, because there was a lot of noise, a lot of news out there. I hope this is useful for you, not just complaining what's the issue about, but also me providing a possible solution. But do take note, everything that I mentioned here, right, is not investment advice. Please do your own due diligence before you go into it. And I can tell you right now, there will be a lot of financial advisors and whatnot, right, clamoring to you to ask you, hey, do you want to consider reinvesting your excess money from your OA, right now you're 55, right, into other investment. Now, my purpose of the video is not to rush you into any investment, but to help you to think about what are the possible options, alright? So, all this policy change, by the way, is only going to come in next year. So, you still have time. You still have 1 year to think about it. So, think about it carefully, give it deliberate thoughts before you make your next move. Please do not rush into any investment or get, coerced or get attracted by all the shiny advertisement, which I'm really sure is going to come out really, really soon. Alright, so that's all I have for today's channel. If you like the channel, do like and subscribe, and I'll see you at the next video.